Hello, welcome to this session. My name is Malcom Tyrrell. I'm one of the retirement and later life specialists at Just. And for the next 30 minutes or so, I'm going to talk you through equity release, making it personal. There's a reason, you would hope there would be anyway, there is a reason why we've called it making it personal. And actually the words personal and personalise and all that kind of stuff will be the common theme throughout the next 30 minutes or so. We have made some changes to the whole of our product range, which is quite rare in the 15 years or so that I've been at Just. We've made those changes recently. So this is an opportunity for me to let you know what those changes are. And just as importantly, why we've made those changes now. Those of you that are aware of Just or Just Retirement as we used to be will probably know that we have been medically enhancing annuities and equity release products to a lesser extent for a very long time now. So we've had the capability, because we reckon we've now got about 1 million years worth of data behind us on medical enhancements, medical conditions, longevity, all that kind of stuff, which is obviously highly relevant to medical underwriting. So we could have done this some time ago, but the reason that we've held out and we've decided to go with it now is because the regulator is also asking for equity advice release to become more personal, and there's that word. So what we want to be able to do is to meet the regulator's requests and give you guys, the advisors, greater facility or greater opportunity to bespoke your advice to your clients. Now, I'm choosing that word really carefully, because what we've done and what we've changed and what I'll tell you about over the next 25 minutes will enable you to offer a totally bespoke product to your clients. And that, I think, at the moment is unique within the business. But anyway, let's move on and I'll show you what I mean. Those of you that may have seen me present before will know that I don't usually go through learning objectives. I'm not going to go through them again today, because what's on there I've already covered in my introduction. So let's get on to the stuff that's much more relevant. There was a paper written by the FCA back in June of 2020, and you can see that it was a fairly lengthy piece. This is only a small extract from it. And I'm certainly not going to sit here and be a really poor presenter and read that out to you. Now, what I'm going to do is I'm going to précis it. And basically all of those words that the regulator was talking about back in June of last year is exactly what I said in my introduction. But what they want you, the advisor, to do is to be able to demonstrate the suitability of advice. And you might think, well, okay, that's nothing new. And indeed it's not. But what they're focusing on is the personalization. There were some other comments that came from the FT advisor, Jonathan Davis, out of the FCA. And he said, and again, I'll précis, that it's critical that advice offered to consumers looking at lifetime mortgages is suitable to their personal circumstances. There's that word personal again. The FCA went on to say that what they're looking for you as the advisors to do is to reinforce the importance of suitable advice in the equity release market. Jim Boyd, Executive Officer at the Equity Release Council. I think there will be an important role for underwritten products. And then lastly, our own Sarah Morris-Simpson, who is our Retail Proposition Director, said that what we at Just are trying to do is help contribute to the FCA's personalisation challenge. So what I'm going to do is talk you through that challenge and what we're proposing or what we've done in order to meet that challenge for you, for the regulator, for your client, et al. So, medically underwritten lifetime mortgages, an introduction. I want to give you a brief idea of what I'm talking about here, and then I'm going to go and look at the market and hopefully develop the conversation around why we've come into the market with this change now. So what is a medically underwritten lifetime mortgage? Well, for those of you that are involved in the equity release market already, or those of you that have limited experience, will probably know that you can give your client a reasonable idea of what they can borrow and at what interest rate by simply knowing their age and the value of their property. But that's hardly personal. So what we're trying to do to meet this guideline from the regulator is give you the facility, the ammunition to personalize that way beyond that. So what we're saying is that if we know the client's health and lifestyle, what we can do is we can create their medical age as opposed to their biological age. And if their medical age, because of their lifestyle, because of their health conditions, etc., happens to be older, then what that should mean is that we can either offer a higher loan to value or a lower interest rate if the client doesn't want to borrow any more money. So that's what I mean by you as the advisor. If you give us that information, we can then offer you the facility to bespoke that product for your client. And I'll come back to that at the end when I talk a little bit more about some practical application of it and what it actually looks like. Because before we do that, what I want to do is just set the scene, really. A lot of this stuff you will be more than familiar with, but hopefully what I've done is we've got a bit of research in here that will dig down a little bit deeper. And I'll apologize up front and say some of this stuff is quite tough reading. It's quite tough presenting it as well, because it's real. We can't just stick our heads in the sands and walk away from this. We've got to know as an industry, as a business, what the reality is when we're trying to personalize things for our clients. So we know that in terms of the pensions landscape, all sorts of things have been changing. I'm not going to go through all of those bullet points, but what I will do is just draw your attention to the ones that we're very familiar with. The decline of DB pensions. I mean, that's now dropped by 15 to 22%. At the same time, of course, what companies have been doing is, unsurprisingly, because it's less expensive, is switching their staff over to DC pensions. And we've seen a big increase in that over the last decade or so. What, of course, that means is that clients within these schemes and clients generally outside of these schemes are having to rely on products that don't offer that key word in retirement, guarantee. We're moving away from guarantees within the pension setup. There are other longer, issues around longer working lives and gender inequality, all that kind of stuff, and you will get copies of these slides if you request them. So I'm not going to go through every bit because I won't have time. But what this means is that of the 11 million people in the UK between the ages of 50 and state retirement age, which of course has changed dramatically, particularly for ladies in the UK, a lot of them have gone from 60 to 66 or 67, which is a huge difference. But anyway, of those 11 million people, only around 3 million of them will not receive even a minimum income. Around 5 million of those 11 will not receive a personally acceptable income, or what they regard as personally acceptable. And around 10 of those 11 million will not receive a comfortable income, or what they regard as a comfortable income. So there is an awful lot of opportunity out there, or an awful lot of clients that will be looking around going, heck, how am I going to afford to retire, or how am I going to afford to live in retirement? Because the other statistic that you will all be familiar with, and I'm not going to go through this in detail, is that our generation will, on average, live longer than the previous generation, our parents' generation. There is every likelihood that our children and their generation will live longer than we do, on average, which is great. Everybody wants to live longer. All this thing, I want to live as long as possible. Of course we all do, or Most of us do anyway. The issue is, how are we going to afford it? Because instead of, if we're in retirement for 30 years instead of 25 years, how is that extra 5 years going to be funded? How is it going to be funded generally? Because the figures are incredible. If you look at the bullet points on the left-hand side, the over 65s are expected to grow by nearly 50% between 2017 and 2040. Here's the really worrying one. The over 85s are expected to grow from 1.4 million to 2.7 million. In other words, they will virtually double in that same period, which is great. All of our parents and grandparents are all going to live longer. That's great. But can they afford to do so? Let's get down to the nitty-gritty of this and the reality of it. The other issue is if we're living longer, are we living healthily? And the answer to that, I'm afraid, is almost certainly for most of us, no, we're not. And this is a slide that I personally find quite depressing, but I'm going to start to cheer things up as we move through this in just a moment. But more than 14 million adults in the UK have high blood pressure. That obviously increases their risk of heart attack and stroke. 4.7 million people in the UK have diabetes. However, there are almost 1 million more living with type 2 diabetes that haven't even been diagnosed. There are more than 200 types of cancer. 1 in 2 people in the UK will develop some form of cancer during their lifetime. And 8.3 of those over 60-year-olds in Great Britain were smokers only back in 2017. Smoking is still the biggest killer in the UK. So with all that in mind, the chances of us living longer and healthy are very slim. And here's another graph. Again, I'm not going to go through this in detail to describe the evidence that that's all based on. And what I want to do with these 6 columns is draw your attention to the first 5, and in particular, the blue chunk at the bottom. And what that blue chunk represents are the numbers of ADLs that we as a population will be living with. Activities of daily living. What you can see is that between 65 and 69, sorry, the first column on the left, the blue column, i.e. those without ADLs, is at its biggest. As it goes through to 70, 80 and beyond, you can see that that line shrinks dramatically. So what that's telling us is that as we get older, and we will grow older and live for longer, as has already been demonstrated, the chances of us living healthily is almost nil. And you can see that the blue ADL box almost disappears when we get to that 5th column. So it has to be expected. You need to be talking to clients about this kind of thing, because with the best will in the world, your clients are going to fit that criteria. So are you making them aware of the bad news? And it is bad news, but it's real. I couldn't do a presentation like this without talking about the impact of COVID. I suspect of the audience out there that pretty much every one of us has been affected in one way or another. What I wanted to do, because again, I won't have time to go through all of these bullet points, is to look at perhaps the 2nd and 3rd here. What we know is that in September, furlough came to an end. As a result of that, what we also know for absolute certainty is the 3rd bullet point, that there will be more job losses as a result of it. So what that has meant is that COVID, this extraordinary thing that's been going on for the last 18 months or so, means that more and more people will come into retirement or early retirement 5 or 10 years earlier than they anticipated. Bearing in mind that it's almost certain that they're going to live longer than any generation before, and they're being forced into retirement earlier, how on earth are they going to pay for it? So what will happen, and again, please take my word for this, because this is going to be the reality, more and more people are going to be forced to look at their assets and go, right, how can we afford to live? Where can we get some capital from? Where can we get some income from? Now, one thing I do want to make absolutely clear here is that I'm not suggesting, and neither are we at Just, that equity release is right for everybody. Clearly, it's not. But you would expect me to be positive about it because I'm doing a presentation about equity release, let's face it. So the reality is more people than ever before over the next 5 or 10 years will probably need to look at their assets and go, right, how am I going to afford to live? I realize I'm going to live longer. I may not be living healthily, but whilst I am healthy, how am I going to afford things? So let's brighten the mood slightly and let's look at a positive figure. Again, I'm not going to go through this graph in any great depth, other than to point out the blue line. And what you can see is the blue line is the total mortgage debt across the UK. And that has been falling since about 2015. The orange part of the columns is the amount of net property wealth. And for the first time in 2016 or thereabouts, those orange columns started to peep above the blue line. So what this is telling us is that more people in the UK than ever before have more free assets in their property than ever before. So the good news from our perspective, from an equity release perspective, is that there should be an even bigger market than there was previously. And what I'm also going to throw into that is this particular graph. And this talks about debt and debt in general. And what you can see is that that will increase over the next decade or so. So what we know for absolute certainty is that people are coming into retirement, and here's the evidence, with more debt than they've ever had previously. And that might be mortgage, it might be personal loans, it might be secured loans, whatever, credit cards, all that kind of thing. 20 years ago, it was almost unheard of to retire with debt. That's now gone away. Most people are comfortable, if that's the right word, with having debt. So this graph sort of demonstrates that case. The problem people are going to have is coming into retirement with less income, with more debt, and living longer. They're going to have to use or find some way of clearing that debt. Otherwise, it's going to bury them, which means more and more people will probably have to look at something like equity release. And what you can see in the second bullet point there is that in 2021, the average 55 to 65-year-old household has in excess of £100,000 worth of debt. We're not just talking a few quid. We're talking hundreds of thousands of pounds. It's an awful lot of money for people to have to repay somehow. So back to what we've done at Just, and to give a little bit more detail about how we think medically underwritten lifetime mortgages can help with what I've just been talking about. In order for us to be able to underwrite, clearly we need some medical information. So what we've produced is what we're calling a common set of questions. These will be available or are available on our portal, and very soon they will be available on all of the sourcing sites as well. So Air Group, AdviseWise, etc., etc. And you may not be able to see these clearly, and it doesn't really matter, but hopefully what you can tell by glancing at these questions is, one, there's not very many of them, and two, pretty much all of them are yes, no answers. We're not asking you to become medical experts. We're not asking you to send your clients off around the house and get copies of all of their prescriptions and all that kind of stuff. If you can give us the answers to these common questions, we will work with that as best as we can and I'll demonstrate the kind of outcomes that we can produce and how you can bespoke your advice to your clients. So let's look at an example. We've got a 70-year-old. And what that tells us is that for the normal 70-year-old, we would be able to offer him a maximum loan to value of 43% on our J4 product. Doesn't really matter. Let's not worry about the actual product. One of our products that will be relevant to him. We would be able to offer him 43% at a rate of 3.92. But let's get some medical information. And as a result of those common questions, what we find out is that the client has had diabetes for 10 years, and he had a heart attack a couple of years ago. That information plumbed into our system then says, actually, you've got a medical age of 73, not 70. So what that then enables us to do is offer him the rate at 73, age 73, which would offer him a further 3% on his loan to value. So he could borrow more money simply because he told us what his medical conditions were. His medical conditions will probably be different to a lot of other 70-year-olds. That's what I'm talking about in terms of bespoking the rate. But let's just say, well, he doesn't want to borrow more than 40%. So the facility to have a higher loan to value is irrelevant. Okay, what we would then be able to do by taking into account his medical age of age 73 is say, all right, you could still borrow up to 40%, but instead of it being at 3.92%, we'll offer you the same amount at 3.72%. So over a 20 or a 30-year period, if he's rolling up his interest, if he's not servicing his interest, that will save him, his family, his beneficiaries, etc., a huge amount of money over time. All because he gave us, or you gave us, that medical information. What we've calculated is that there is every likelihood that if you don't collect that medical information, 2/3 or 6 in 10 of your clients could miss out. Hopefully, when you get a chance to look at those questions in more detail, you will understand how simple they are and how little detail we're asking your client to provide. As a result of that, we could do some extraordinary things for your clients. And I just want to finish with a couple of examples. Firstly, we've got Lisa and Alan. Lisa's 63, Alan's 66, and they currently live in Lisa's 4-bed house, valued at 600,000. Lisa has high blood pressure, probably because she's divorced and her ex-husband still owns part of the property. So what Lisa would like to do is raise enough capital to pay him off and own the property in her own right. Once that's done, her and Alan can get married. They can do all the things that they want to do in their house. So, armed with that medical information that I've just told you about, without medical information or without medical underwriting, the interest rate on a standard product will be 4.75%. With medical underwriting, it's 4%. So we are not just talking 0.03%. We are talking here over 0.5% reduction simply because Lisa has given us that information. What that does is it saves them or her 0.57%. And over up to her age 90, on a rolled up basis, the difference would save her and her family £58,000 in interest. What that will then enable them to do is exactly what they would like to do: own the property, get married, and move on. Let's look at Anika's story. Anika's single. She's age 63. She's got a 3-bed house valued at 250. She was diagnosed with bowel cancer 16 months ago. She's self-employed. She's not sure that she even wants to go back to work when she's healthy again. But at the moment, she's not working for medical reasons. She wants to raise the best part of £50,000 to clear off her outstanding mortgage. She's not comfortable with moving into retirement or semi-retirement in debt. She's been diagnosed with the cancer, as I mentioned, and she's gone through the pandemic with it. She now wants to make every second count, so she's keen to maximize the amount that she can borrow. She can then, if necessary, pass that on to the children and the grandchildren. She's also never owned a new car, so she's thinking, well, perhaps now's the right time. By using that medical information, we can up her maximum loan to value from 34 to 37%, an increase of 3%, or an overall increased lending facility of £7,500. We can only do that if we've got the answers to those medical questions that she shared with us on that previous screen. So the medical underwriting facility in this example enables her to maximize her potential way above what she could have borrowed previously, pay off the mortgage, reduce the financial stress, help the kids out, and buy that new car. All because she was asked for her medical information, and that made a huge difference to the amount that she could borrow. What difference does it make to you as the advisor? Well, very little. Here's the underwriting process fitted in to the equity release application process. And all you can see is there's an extra box, third down on the right. We require the medical information, which will be available as part of the KPI application process. At the moment on our portal system, by the end of the year, with all of the sourcing providers as well, and it will simply sit neatly in that process. If you can, with the application, with the KPI request, give us that medical information, we will do the medical underwriting as part of the standard process, and we will let you have a KPI with the increased interest rate on it, the reduced interest rate on it, or the increased loan to value, or both, depending on what the medical conditions are and how it works out. There is very little additional work apart from answering those simple questions required from the advisor. So what are the next steps? Well, please review your fact-finding process to include a medical question set, that common set of questions. If you don't ask medical questions already, please get into the habit of doing so. We're not asking for huge amounts of detail. If you feel as a firm or as an individual you would like additional underwriting training or additional portal training with any of the sourcing providers, please let us know or let TMA know, and we will make sure that we get that information to you. Or you could simply contact your account manager, and I'll give you the details on the next slide. The key thing, as far as I'm concerned at the end of this presentation, is that please don't let your clients miss out. It is so simple, it is so easy, and if 6 in 10 of your clients can benefit, that has to be a real prospect, and as part of your advice, a really important part of the process. So there's our call to action. As I say, you can have copies of these slides, but if you would like more information on anything that I've said, or anything that we've got available on our portal or our websites, please let Joe know, and we will make sure that we get that information to you. There's my learning outcomes. I didn't go through them at the beginning. I'm not going to go through them now, simply to finish off by putting that slide up and saying, I hope there was something in there that was of value and of interest to you. And if I or any of us at Just can help in any way, please let us know. And thank you for listening.